All right.
Welcome. Today, we're going to break down the essential tax rules that come into play in a taxpayer's final year. Now, these aren't just minor administrative details. They actually contain some very unique provisions and, believe it or not, significant planning opportunities that are absolutely critical for any student of taxation or an executor to fully understand.
So, here's our roadmap. We're going to cover 5 key areas. We'll start with the special, and I have to say, quite generous rules for losses. Then we'll look at the returns that have to be filed, including a really powerful optional one. After that, we'll see how to strategically use tax credits, and we'll wrap up with the unique way donations made by will are handled. Let's get started.
All right, let's dive right into our first section. This one covers a really critical departure from the standard tax rules, and it's probably one of the most significant planning opportunities you'll find on a final return.
So this is the big question. You see, under normal circumstances, how you can use capital losses is pretty restricted. But in the year of death, the Income Tax Act carves out a special, much more lenient rule. And understanding this is absolutely key.
This slide really shows the stark difference. In a normal year, if you have a net capital loss but no capital gains, that loss is basically useless for the time being. But in that final year, everything changes. That same loss can be used to offset any kind of income. We're talking employment income, pension, interest, you name it. So just imagine a final return with, say, $50,000 in pension income and a $50,000 net capital loss. Any other year, there's tax owing. But in the final year, that loss could wipe the taxable income down to zero. It is an incredibly powerful provision.
And the planning potential doesn't even stop there. The rules actually build a bridge between the estate and the deceased individual. So if the estate itself realizes a net capital loss or a terminal loss in its first year, a special election can be made. This allows you to carry those losses back and apply them against income on the deceased's final return. It's a fantastic tool for syncing up the tax positions of the individual and their estate.
Okay, let's move on to the main filing requirement, which is the final return itself. You'll sometimes hear this referred to as the terminal return.
So this return, it's not optional. It is the fundamental duty of the executor. Its job is to report every bit of income the person earned from January 1st of that year right up to the moment of their passing.
And here's a really crucial point. Even if the person passed away on, say, January 2nd, you still get to claim the full basic personal amount, the full age amount, and all those similar non-refundable credits for the entire year. You don't have to prorate them. That's a huge and really beneficial aspect of this filing.
Now, beyond that mandatory final return, the tax law actually provides for a few optional returns. And by far the most important, the one we see used most often, is a return for what are called rights or things.
Let's be really clear on this definition. A right or thing is an amount that the deceased had a clear, legal entitlement to at the moment of death, but the cash just hadn't hit their bank account yet. The key factor here is the certainty of that entitlement.
This slide gives some perfect examples. Think about a stock dividend that was declared on June 5th. The taxpayer passes away on June 10th. Because the right to that dividend was locked in before death, it qualifies. Now contrast that with interest on a GIC that builds up daily but is only paid out at maturity. Since there was no right to receive it before death, that interest does not qualify as a right or thing.
Filing this optional return isn't just about paperwork. It is a core tax planning strategy. By deciding to file it separately, what you're really doing is creating a second taxpayer for the year of death. And that opens up some really powerful opportunities to reduce taxes through what we call income splitting.
And this table just lays out the advantage perfectly. Let's say you report $50,000 of rights or things income on its own return. You get a second trip up the graduated tax brackets. That income starts being taxed at the lowest rates all over again. And, crucially, you get to claim a second, full, basic personal amount and certain other credits against that income. The tax savings can be really substantial. Of course, it's essential for executors to know the specific deadlines for this optional return. As you can see, they're actually more generous than the standard filing dates, and that's to give the executor time to gather all the information and figure out if filing this separate return is really the best strategy. Okay, so now let's get specific about how we can strategically apply tax credits across these different returns to really maximize the deductions and lower that overall tax bill.
You have to make a really important distinction here. The credits you see in that first column, the ones related to a person's status, like the basic personal amount or the age amount, you can claim those in full on both returns. The thinking is that the taxpayer existed for the year.
But the credits in the second column, the ones based on specific payments like medical expenses or pension income, those have to be allocated. The total you claim across all returns can't be more than what would have been allowed on a single return.
And this just ensures there's a logical link. The rule of thumb is simple. The credit follows the income. So if the employment income is on the final return, the Canada employment amount has to be claimed there too. If pension income gets split between returns, then the pension income credit has to be allocated in a way that makes sense based on where the income is reported.
All right, let's move on to our final section. Here, we're going to look at how charitable donations, which are often a key part of an estate plan, are treated for tax purposes. Now, the timing here is absolutely critical. The donation is considered made not on the date of death, but at the moment the executor actually transfers the property to the charity. This delay is written into the law on purpose, and it gives the legal representative a tremendous amount of strategic flexibility.
This flexibility means the executor can be incredibly strategic. They can look at the income on the estate's return, on the final return, and even the prior year's return, and then they can put that donation credit exactly where it's going to save the most tax. It's a really powerful optimization tool.
And this number, 2, is the key. The ability to carry that donation back not just to the final year, but to the year before death. That is an incredibly powerful look-back opportunity. This means an executor can go back in time, essentially, and reduce taxes from a previous year, potentially generating a big refund for the estate. And of course, that increases the value of the assets that can then be distributed to the beneficiaries according to the will.
So, to quickly recap our key takeaways, the tax rules in the year of death are definitely complex, but they aren't just there to be difficult. As we've seen, they have very specific provisions for capital losses, for optional returns, and for donations that create some really distinct opportunities for careful planning to minimize tax and maximize the value of an estate.
And this is really the question I want to leave you with. Understanding these rules isn't just an academic exercise. For an executor, it's a fiduciary duty. Effective postmortem tax planning is really the final act of good financial stewardship, and it ensures that a person's life's work is preserved and passed on as efficiently as possible.